Hello everyone and welcome to today's Mondac webinar in association with King Spalding, who will be examining trends and developments in AML enforcement and compliance in 2023 while identifying risk areas to prepare you for 2024. My name is Dan Sampaio and I'm joined by a brilliant panel to take us through today's discussion. Matthew Biben is a leading lawyer at King Spalding, representing banks and other financial institutions in a broad array of compliance and enforcement issues, civil disputes, securities litigation, and complex matters involving regulators. He resolved wide-ranging BSA, AML, and sanctions issues for global clients and addresses compliance and risk management program concerns. Matthew has published widely on AML issues and has extensive experience advising state-chartered and national banks on all forms of regulatory compliance and enforcement questions. Olivia Radin is a partner at King Spalding, focused on regulatory and internal investigations. She defends and counsels global companies in response to congressional inquiries, internal and regulatory investigations, and significant global risks. She represents clients in financial services, technology, consumer, and other industries across a broad range of matters, including those relating to allegations of fraud, bias, data breaches and privacy violations, bribery, improper sales practices, workplace misconduct, accounting and securities fraud, market manipulation, anti-money laundering violation. Now, before I hand over to the panel to begin today's webinar, a couple of housekeeping items. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page, and the panel will endeavour to answer as many questions as possible, but any we don't have time for will be sent on to the panel, who will be in touch. This webinar is eligible for CLE credit, and if you would like to claim this, you will need to download and complete the CLE form that has been added to the toolbar. A code will be announced during the course of the session that you will need to include in this form. Finally, to submit, please send the form to the email address highlighted on the document. It's now my pleasure to hand you over to Matthew and Olivia to begin. Thank you.
Dan, thanks very much. Good morning, everyone. We're coming to you live from K&S Studios here in Midtown Manhattan, or put differently, a King Spalding conference room. I'm here with the incomparable Olivia Radin, as Dan said, and we're delighted to talk with you today about the enforcement trends coming that we expect in 2024 and the events that have taken place in 2023 in the anti-money laundering, bank secrecy act space. Let me briefly introduce myself and then ask Olivia to introduce herself. As Dan indicated in his opening remarks, I've been doing anti-money laundering BSA work for a long time, almost 30 years. Started my career as a prosecutor, both in state prosecutor and a federal prosecutor in the Southern District of New York. I did that for a dozen years. I prosecuted narcotics crimes, white-collar fraud, and organized crime, all that also involved money laundering issues. After that, I went in-house. I was Deputy General Counsel of the Bank of New York and Bank of New York Mellon during its period of two enforcement actions, one with the Southern District of New York, one with the Eastern District of New York, both related to anti-money laundering violations, one funds transfer, the other failure to file a SAR, and helped rebuild its program, anti-money laundering program, during my tenure. After that, I went to JP Morgan Chase, where I was general counsel of all of the consumer businesses, and during that time period, we had the Madoff settlement and other challenges related to KYC, BSA compliance, as so many banks did. I've been in private practice 9 years, and my work, as Dan indicated, includes working on behalf of state-chartered foreign banks, national banks, dealing with various regulators in both compliance and enforcement actions related to the Bank Secrecy Act, anti-money laundering issues. Olivia?
Thanks, Matt. Hi, everyone. Nice to see you. My name's Olivia Radin. I'm a partner at King Spalding. Delighted to be here and really glad you're joining us for this webinar. It's going to be great. I work on a lot of internal investigations and government investigations for a range of companies, as you'll have heard. From the beginning of my career, I've worked on AML issues, including being part of an AML monitorship team, and we'll talk about monitorships later in the program, but based on that experience and my other work doing investigations for banks and really digging in to the weeds of compliance programs, I also counsel financial institutions on their AML obligations and help defend financial institutions when there's a regulatory inquiry. So we're really happy to be here and talk about AML issues with you today.
I think we'll turn now to a brief kind of history that gives us some context leading up to 2023. The next slide, please. Thank you. So this is a brief history. This is kind of highlights of 40 years of the Bank Secrecy Act. It was promulgated in 1970, started really addressing filing requirements. It was more of a record-keeping statute. It was found to be constitutional by the United States Supreme Court in 1974. And it really was focused on organized crime, and that was the kind of core of that was being addressed by the original Bank Secrecy Act. It evolved over time as additional statutes were passed and additional requirements were imposed. So you have the Money Laundering Control Act of 1986, along with the Nunzio-Wiley Anti-Money Laundering Act of 92. That was in reaction to the war on drugs. The focus moved from organized crime to fighting narcotics trafficking. It made violations of the Bank Secrecy Act a federal crime, and it required minimum standards for anti-money laundering programs. It also heralded in the beginning of a shift as federal prosecutors, as well as state regulators and federal regulators, began to focus on bank compliance and financial institution compliance. So originally the idea was they were deputizing, the government was deputizing banks and financial institutions to be essentially confidential informants, to provide information on their customers to banks, to regulators for the purpose of investigations, snitching, if you will. But the idea was to focus on the customers of the banks and what their activities were. As the 90s kind of went forward, and Nunzio-Wiley in particular moved the needle on creating federal crimes, you began to see a focus that brings us basically here today, but the beginning of a focus on compliance and whether or not banks were doing all they could do in particular, and you began to see the beginning of penalties. In 1994, FinCen was created, and in 1996, they promulgated the first real SAR regulations. And it's at that point that you begin to see the greatest focus. There were some settlements, big dollar amounts, including the Bank of New York settlement that I was a part of before this. But what you begin to see afterwards is a cascade of enforcement actions involving banks. Let's go to the next slide, and we can move from the war on drugs to the war on terrorism. And so the Patriot Act is passed in 2001. And again, that's a reaction to a change in priorities of the federal government and enforcement. And again, the BSA is moving along with it. This included the 314A, 314B information sharing provisions. And it was, again, kind of the era of huge fines that began to be imposed on banks because of the view that they were not doing all they could to be helping the government with its enforcement priorities. The sea shift that takes place, the sweeping changes that take place in this space are the 2022 Anti-Money Laundering Act. And we're going to spend a bunch of time later today because you're beginning to see the consequences of that new legislation play out in enforcement actions and in trends and compliance priorities. But that included a number of new requirements and a number of enhancements to existing requirements. And so most importantly, in terms of enforcement action this year, it explicitly or expressly extended the Bank Secrecy Act to include virtual currencies, digital currencies, crypto assets. And there's a number of settlements that have taken place this year that as a result of that. It created the Beneficial Ownership Registry, the Corporate Transparency Act, which has created a bunch of compliance issues for various entities that are not used to being subject to FinCen regulations and these types of requirements. It increased penalties meaningfully. It increased the whistleblower incentives, created clawbacks for senior executives. It extended extraterritorial jurisdiction for investigations of entities that were not doing business in the United States, including banks that did not have a presence here. And so in any event, it was sweeping change, and we'll talk more about that in a minute. Why don't we talk now about some of the key components of the BSA?
Awesome. Thanks, Matt. So as you heard from Matt, the kind of purpose of the BSA is to cause financial institutions operating in the United States to really have their eye out, to be snitches, as some might say, but to basically look across all transactions and alert the federal government as to when there's a suspicious transaction, when there's suspicious activity. And in addition, to file reports under certain circumstances. So when there is suspicious activity, and then to file reports regarding certain transactions, currency transaction reports when there's a transaction above $10,000. So if that's the purpose, how does that happen? That's a huge task, right? If you think about the volume of the US financial system, the directive to banks and other financial institutions to basically look across all of that and let us know when there's a suspicious transaction is a pretty big directive. And so that has developed into these compliance requirements you see on the screen here. The first 4 are set out by statute, and the last was codified by regulations issued more recently, but really was those regulations were restating existing requirements, though they're a bit strengthened through the regulations. So what are those requirements? The first, as you might expect, is to have a system of internal controls to implement the requirements of the BSA and detect suspicious activity. Those written controls should be represented through, those controls should be represented through written policies and procedures and should be risk weighted. And that's really the foundation of your program is, I'm sure you all know this if you're attending the CLE, but it's a good reminder, every financial institution has a duty under the BSA to evaluate the risks inherent in its business and to design adequate controls to address those risks. That is not a static thing. That has to happen kind of at some periodicity. So you are addressing the risks in your business as your business grows and develops and changes. And we're going to talk about how that can play out in enforcement actions later in the program. The second requirement is to conduct independent testing of those controls, both to determine if they're operating as intended, but also to assess whether they're effective for addressing the risks of the institution. That independent testing can be conducted by a third party, or it can be conducted by an independent group within the institution that's not responsible for the implementation of those controls to begin with. So you don't necessarily have to hire an outside party to do your AML testing, but it is often the way it is done. The third component is the designation of a BSA or AML officer, somebody who's responsible for the US AML program. That job does not have to be the only job that person does, but be prepared to explain why that person has sufficient skills, experience, and resources and time to do that job well. So this is not a tick the box exercise. You don't want to just give somebody the title of the US BSA officer, but they can have other jobs as well and other responsibilities depending on the size of the institution. Training, of course, is an important foundation for any compliance policy and continues to be here. And then, as I mentioned earlier, more recently, FinCen has introduced regulations on customer due diligence and KYC, really driving home the foundational importance of CDD, customer due diligence, and implementing some beneficial ownership requirements, which kind of overlap with the Currency Transaction Act that we'll talk about, the CTA, which we'll talk about later. But customer due diligence is an important foundation for any compliance program. I haven't even really talked about transaction monitoring, which really falls into the internal controls bucket. But as you all will know, conducting generally automated monitoring of your transactions to detect potentially suspicious activity, and then having an adequate system and process for reviewing those alerts and dispositioning them is the bedrock foundation of most AML programs. So we'll talk about that more as the program proceeds. Matt, can I pass it over to you to talk about those enforcement actions?
Yeah. So 2023 trends. First, I would say, and as Olivia went through those requirements, they're so straightforward on the page and so exasperating for our business partners and clients, where regulators' expectations keep changing, goalposts keep moving, and somehow those simple words on the page of what is required ends up being very difficult to implement and to continue to update as required, as Olivia referred to. So yeah, the first trend in enforcement we want to talk about is a trend that it feels like, every 10 or 15 years, you're always talking about this, which is there's more. What's happening in enforcement, there's more of it. So here you might be able to point to kind of a COVID lull in terms of enforcement. I think that's probably what accounts for 2021 being relatively light on enforcement actions because of the 2020 kind of work from home effect on regulators and prosecutors. But according to the FT, there's a huge surge in penalties 2022 over 2021 with $5 billion, they did the counting we did, and $5 billion in penalties being imposed in 2022. Based on mid-year of 2023, that's already up to 6.5 billion, and that doesn't include the 4.3 billion of Binance, which announced after that number was computed. So what you're seeing in terms of the amount of penalties, also the volume of enforcement actions is a meaningful uptick, not quite a hockey stick, but a meaningful uptick. And we'll talk a little bit more about some of those details in a minute. You can go to the next slide. So here's one of the most important areas of focus, and it's been striking how active the various agencies, enforcement and bank regulatory, have been in this space. One thing to note is how many of these enforcement actions are a combination of multiple enforcement agencies, so not just one agency, and that happens a lot in AML investigations and resolutions. But the tornado cash on the top, as you see, Department of Justice, this is a DeFi platform, and I think the way to think about Tornado, Binance, there's a whole bunch that we didn't put on here. I'll come back to Coinbase in a minute, but Bittrex, Helix, BitMEX, Bitslotto, the number of cryptocurrency, crypto asset players that have been subject to meaningful Bank Secrecy Act, AML enforcement actions is striking. And there are certain kind of common features that you can look to, and one of them, frankly, is cultural. So banks and larger established financial institutions are used to these expectations and requirements of regulators and of complying with the Bank Secrecy Act. The culture of many of these organizations is much more of the move fast and break things mindset from Silicon Valley, or as CZ said at Binance, the better to ask for forgiveness than seek permission. And $4.3 billion later, that's a pretty expensive forgiveness that you're now asking for. So again, I think some of it reflects cultural differences. Olivia had made the point we were talking before, which I think is very insightful, that part of it may also be that a number of these organizations aren't sure if the business model is going to succeed. And so they push forward trying, to prove that the business model is going to work. And by the time it is working, they have not made the investment in compliance necessary to keep up with the various expectations of the regulators. And then contrast those, I think, with something like Coinbase, where you see an organization that, again, according to the DFS settlement, was trying to keep up. So it was not a lack of commitment. It was not a cultural issue like some of the other organizations we're talking about, but instead it was just an ability when the business took off to be able to catch up with the compliance resources necessary to comply. And so I think what you see in each of these are different ways that you end up with failures to comply and meaningful enforcement actions coming from the various regulators. And again, it's the DOJ, it's OFAC, it's New York Department of Financial Services, it's FinCen, it's the Federal Reserve Bank and New York Fed, and others at Treasury. So this is an area that will bear continued attention. I expect it will, again, continue to receive enforcement priority because it is such an important area. Olivia, let me turn it over to you to talk about cross-border flows.
Awesome, thank you. Just on the catch-up point, it seems to me that AML compliance is hard, right? Like it's operational, it's complex, it takes a long time to implement the controls I was talking about. Transaction monitoring generally requires implementing these really intensive automated programs, have to hook up with the rest of your data sets, and data integrity has to be addressed. I mean, it's hard. It sounds easy, but it's really difficult. And so if a financial institution's in a position where it falls behind, A, it's really important to catch up, and B, it's really hard to catch up. So to the extent you're able to, it's always better, I think, to work on this in kind of a programmatic way from the beginning and get these processes going so you can revisit them periodically. And if you do find that you've fallen behind, that's really a time to raise the red flag internally and let people know that your hair is on fire, because it usually only gets more difficult, both for the institution and for the compliance department. And at the end of the day, it's senior management and the board that owns that risk. And of course, there have to be limits on the resources that are devoted to any endeavor of an organization, but really addressing the resources and where you are on an ongoing basis is very important.
That's a really important point. Let me just add one other thing, which is to the compliance folks out there, the lawyers who are trying to deal with business partners, the other message coming out of the digital asset enforcement actions is that the effort to try to take advantage of US markets and US customers, but view yourself as operating outside of the US and therefore not subject to US compliance requirements is clearly a failed strategy. I mean, that's what you're seeing over and over again, is firms that try to kind of keep a fine line between doing business in the United States and yet somehow accessing US customers. And what the clear message coming out of these enforcement actions is that's not a line that you're going to be able to hold, and that if you're doing business in the US with US customers, you're going to be subject one way or the other to US compliance requirements.
Which is an excellent segue to this slide, because that's really the point of the slide. So it's called Focus on Cross-Border Flows, but really we probably should have called it, if you're dealing with the US, be aware of US compliance requirements, because that's what these two huge enforcement actions show, right? So we've been talking about Binance, and I think Binance was, there was some pretty extreme language in the Binance documents, right? Like that was a more extreme example. But there's also language in the Binance settlement documents that simply just talks about, as Matt said, accessing US customers, right? So if you are a financial institution that's based solely outside the United States, no operations in the United States, but you have US customers transacting through your platform, that is operating in the United States for purposes of US AML laws, which carry criminal penalties, right? This is actually very unusual in the United States to have a compliance regime where willful failure to implement a compliance regime is itself a crime. Usually there are other criminal statutes that apply, and you look to the compliance regime to address scienter. But here, the failure to actually have an adequate compliance program can itself be a crime. So this is very serious stuff. And if you're a institution wholly outside the United States accessing US customers, you can end up with a criminal plea deal, and your executives can be subject to criminal exposure. It's very serious and needs to be taken very seriously. The Danske Bank settlement is a different way of getting at the same issue in my mind. And there's also a point about M&A that I want to make here. So Danske Bank acquired a Finnish bank in 2007. That Finnish bank had an Estonian operation that serviced a lot of Russian customers and other non-Estonian resident customers. So you're thinking, like, what does this have to do with the US? A lot of the non-resident customers in Estonia were doing US dollar transactions. Again, like, seems kind of tangential. But in order for Danske Bank to serve those customers, Danske Bank had to have US dollar accounts at US banks. Okay, so Danske Bank is a customer. It's not operating as a bank in the US. Where does AML come in? Here's where it comes in. The US banks, of course, have US AML obligations, and so they asked Danske Bank a series of questions over many years about their AML practices so that they could feel comfortable providing those accounts to Danske Bank. And the allegations, I suppose admissions, were that Danske Bank lied in response to those questions. And so that caused the US banks to conduct transactions that they would not otherwise have conducted if they'd gotten truthful answers about the state of Danske Bank's AML program. And so this settlement was charged as bank fraud. And I think the takeaway message there is that even if you're not operating in the United States, you are subject to AML laws if you're interacting with the U.S. financial system in any way, because U.S. banks, if they're implementing their obligations correctly, which most banks we deal with have excellent programs, they will ask a series of questions, and then that exposes the bank to U.S. AML requirements, a la Danske Bank. So I think the takeaway from this slide is don't discount the U.S. even if you're not based here.
Yeah, and as you said, it was a bank fraud violation, not a Bank Secrecy Act violation, notwithstanding that all of the allegations were about its anti-money laundering deficiencies and its BSA program, but it wasn't charged that way, and as you said, they still were able to reach them.
I think because it couldn't have been charged that way.
Correct.
To the point you're making, but you're right, it was an AML case just charged as bank fraud.
One way or the other, they figure out how to get you.
Exactly. I think we can go to the next slide, please. So this slide is really just a reminder that broker-dealers and mutual funds are also subject to the BSA. The Division of Examinations within the SEC conducts regular examinations and issues risk notices, warning of various risks. And so, be aware that while broker-dealers have not been the subject of the same, for the most part, but not always, the same level of BSA-related enforcement actions. We cite here a couple of smaller enforcement actions. These requirements apply equally to broker-dealers. And I think here I would be remiss not to mention, the overlap between the BSA and sanctions regulations. It may not actually be the right slide to mention it, but I'll mention it because it's on my mind. There's a very strong overlap between the systems that financial institutions have in place to address the requirements of sanctions laws with the systems that they have in place to address transaction monitoring. They're often part of the same end-to-end compliance program. And so, your AML risk can arise in many different ways. Whistleblower can raise an issue. There can be a transaction that comes to the attention of authorities some other way. But you could start out with an issue that's a sanctions investigation or a sanctions issue, and it can quickly turn into an AML issue and vice versa. And we've seen a number of big enforcement actions, like really big enforcement actions, where that's the case and you get a joint sanctions and AML violation. If we can move on from this slide, Matt, over to you to discuss our next trend.
Yeah, so Shinhan, which was a settlement, Shinhan Bank settlement in September of 2023. Again, this was a settlement with FinCen, New York Department of Financial Services, and the FDIC, joint enforcement action, and related to the failures of their AML program. This, unlike the crypto asset cases that we talked about earlier and some of the others, this is a real meat and potatoes, blocking and tackling kind of enforcement action that, again, should just serve for all of the regulated financial institutions, money transmitters, others, as a kind of wake-up call that the regulators are going to continue to focus on the types of cases they've brought in the past while still pushing new boundaries. So this one, again, fairly traditional tax evasion scheme, corruption funding, traditional money laundering type issues that were flagged. It's a South Korean bank, but the key here is that it really stemmed from KYC failures. And Olivia talked earlier about transaction monitoring being kind of one of the cornerstones, obviously, of an effective compliance program, effective BSA program. But really where you start is KYC, knowing your customer, updating that information, making sure that the information that goes into your transaction monitoring systems, the information that allows you to assess the activity of a customer versus what should be expected, is up to date and is maintained. And here what you have is a failure in that regard, failure of the risk assessments because the KYC information wasn't up to date. And again, the reason that this case I think is so important coming in September of 2023 is not for the, I think it was 10 million to DFS and maybe 15 otherwise, but to the other regulators, maybe it was just 10 in total. So it's not the dollar amount compared to, again, a Binance with the billions of dollars of settlements. What really matters here is the heart of this enforcement action arises out of supervision failures. So going back to 2015, there were findings by the examiners, the supervision staff of FDIC, and I think DFS also, indicating that there were KYC deficiencies that needed to be addressed, KYC issues that needed to be focused. And this is a pattern focused on by management. And this is a pattern we see over and over again, which is the open MRAs, the open MRIAs, the open comments from supervisors end up forming the basis of the enforcement investigations that follow. And so here there's a very direct line, is noted in the enforcement settlement, from those failures to address the earlier KYC findings to the ultimate resolution and settlement. And again, you have some difference in language between the way the regulators see this, which is always that management, quote unquote, ignored, and you have, the management that may have been trying, may have addressed it, may have thought they had addressed it, may have insufficiently addressed it, may be a new issue that popped up from that same old issue. In any event, the way you're going to read about it when the regulators ultimately get you to settle is that they're going to characterize what you did as ignored the deficiency, and that's what then led to the enforcement action. So again, for the case in and of itself, not significant in dollars, not significant in findings, but very significant in reflecting where the regulators are likely to continue to focus, which is both, again, the envelope, but also the heartland issues of BSA compliance and focus on KYC and your program requirements.
I think it goes back also to the risk assessment point, because it puts the institution in a very difficult position if in the course of a supervisory review, the institution's been told, you have to look at this issue, and then you have documents in your company records that just leave it open, even if you did take some action or disagree with the finding or think you've resolved it. So, what do you think about record keeping in that situation?
It's a great point. And you do see, so there's a combination of issues, which is, oftentimes the regulator, even though you believe the issue has been addressed and closed, doesn't respond. And so you're left kind of feeling as if the institution is left feeling as if you have addressed it and moved on, and they can come back and say they never closed the issue. The other thing is that they will take a generic finding, KYC deficiency. Now the details underneath that headline are going to be, call it, totally unrelated to whatever comes 3-4 years later. But what we see again and again is they take the headline and say, there have been a pattern or history of KYC failures at this institution, this bank, at this money transmitter, whatnot, going back to, and then they cite that. And it's unfair, and we get involved and advocate, but again, it's hard to move them off of that conclusion that you didn't address, or that you addressed it but not sufficiently, because going forward, you fell again, you tripped again over the same issue. So I think that's a great point. The record keeping, as you said, also is a management question. So the other thing we see in this space is when the enforcement actions begin and the subpoenas fly, or the CIDs or whatnot, there are questions about oversight and who received the reporting of the information about KYC failures. Was it escalated to management? Did it make it into board packages? And so, again, going back to the basics, here you have to tick and tie and make sure that you can defend when they come, not just what you did on the ground, in the business line, desktop procedures, remediation of files and the like, but also the oversight that is necessary by management, business lines, first line of defense. So it's not just, second and third, as well as the board. It's a great point.
And I think demonstrating all of that, any kind of tick and tying, it's so much easier if you have a plan in place from the beginning, because then you can have, you can trace through what the roadmap is for how you responded to a particular MRA, how it was escalated, when the board was told about that. So if you have policies, and many institutions do, of course, if you have policies in place for your risk management that address this specific issue, it helps you get attention as you need on any issue that's subject of an MRA or MRIA. Also, internal audit, other sources of issues that come to your attention, and then it helps you defend later if a regulator says, well, we pointed this out to you and you didn't do anything, you can actually say, look, actually, here's our record showing we did something. It may not eliminate the issue because it's kind of, if you do trip again over the same issue, it's kind of an easy give for the regulator to say, look, we pointed it out and you did it again, but it helps, it helps you position the institution in the best way possible, which is what you're trying to do in that situation.
Great. Can we go to the next slide on monitorships? So the next trend that we wanted to talk about is the use of monitorships. And this is a bit of what I would call Groundhog Day. So, there was a period, as I said, the 2000s and forward, where monitors and compliance consultants were all of the rage. Every settlement seemed to want to have a monitor as a part of it. We'll talk about how great an imposition that is. But then there were issues of corruption that were raised, cronyism issues, and you got to the Trump administration and Benkowski, and they were disfavored, and all of a sudden it became, monitors were not something that was going to be regularly imposed, and you saw a tremendous drop off. And then you have Lisa Monaco, and then DOJ under the Biden administration put out the call that they're now going to once again be positively inclined towards monitors. And you see them, and what's interesting is that's all at the DOJ level, but you see them at the state level with New York Department of Financial Services. You see them other places as well. And so, as I say, it's like the past is prologue to the present or something. Prelude to the present. In any event, it's Groundhog Day. So we're back with monitors. And so the issue with monitors is, as you see on the slide, Binance has one, Coinbase had one that was extended, and there are others that are coming. But monitors are incredibly intrusive, incredibly expensive. They distract your management and your businesses, and are much greater imposition than mere financial penalties. When I was at Bank of New York, I had a monitor for 4 years that oversaw the implementation of our revised Bank Secrecy Act program, compliance program, and reported to the DOJ frequently on it. In private practice, I've negotiated the imposition of monitors, managed monitors, both those that are publicly known and those that were imposed by regulators and not made public as part of MOUs. And I can tell you from those experiences, it's a really challenging exercise, and the personality of the monitor is hugely important. And so, again, making sure that you can do whatever is possible to get the best monitor possible, both substantively as well as temperamentally, is critically important. But the one thing that I haven't done is actually been on a monitor team, and Olivia has. So why don't you tell us a little bit about what that's like from the inside?
Yeah. So just to frame it, as Matt was saying, the mechanism of the monitorship is that in the course of some kind of settlement or MOU, the company agrees to basically revamp its compliance program usually. And because it's such a big revamp, it agrees, this is kind of the mechanism, the idea, it agrees to have a monitor imposed to monitor that. And then the monitor writes a report, usually annually, to the regulator at issue, giving the monitor's detailed view of whether the company is meeting its obligations. And then often the regulator has, at its discretion, the ability to yank the settlement. And so the monitorship report and what the monitor is doing is a big deal, right? The monitor's name is on the line in terms of saying this company that had a major settlement is now on the right track. DOJ or the other regulators are, putting a lot of weight on has this company done what we said it would do? Their name is on the line. And then the company is working really hard to implement, as we said before, what's a very difficult thing to do. So if you just start from there, oh, by the way, the company pays for the monitor. So Matt mentioned how expensive it is. The monitor is a monitor plus a team because this is a big job. So, it could be many, many people whose job it is to understand your compliance program inside out while you're building it, right? It's like the expression of they're building the plane while they're flying it, and then write a report, and you're paying for that and you don't want them there. So it's a difficult situation to begin with. What we always say to clients who have a monitor imposed after we have tried not to have that imposed in the settlement discussions, is that the way you approach, as Matt said, the monitor themselves are very important. You're not going to totally control that, who gets selected. In fact, you won't control it. the way you approach the monitor is very important, because the monitor has a job to do too. And you want to try to get on a good footing with the monitorship team when you start. So I think being prepared in terms of understanding how expansive that role is, what type of information they're going to have access to, and then thinking about how to provide that information to the monitor is really the right way to start. And we could have our own CLE just on this issue, right. So I won't spend too long on it, but it's being on a monitorship team, you're on the other side of that coin. It's a big job, and if you ever do have a monitor imposed, we should talk about how to prepare for that.
And the monitor cares a lot about their reputation, and some of our building blocks for creating positive regulatory relationships apply there. You want to establish trust. You want to make sure they're not embarrassed. You want to try to keep them from ever having to report that the company doesn't get it, right? I mean, those would be the key.
Yeah.
Next slide is compliance trends and SAR filings, and there's a lot of SAR filings going on in the world.
There are a lot of things there are a lot of SAR filings. Some question what the purpose of the SAR filing is, given that the obligations we've been discussing can lead financial institutions to file defensively, as you might expect, right? So there are a lot of SAR filings. It's not like someone's sitting there reading all the SAR filings, so that might lead some to query what is the point of this database. And I think periodically there's discussion about whether to change the standard for filing for suspicious activity. But what we're really seeing is just this level of SAR filings continue to grow as the financial system gets bigger and bigger, and as there are more AML enforcement actions reminding people of how important those obligations are. There is a proposed rule which has not yet been finalized regarding the sharing of SARs across financial institutions, including with foreign affiliates. That would be a pretty big change. Right now, the rule is that you cannot share SARs outside the United States. And you have to have controls in place to ensure that that doesn't happen. The rule was expected last month and hasn't been published yet, hasn't been finalized. I know from my own experience that if SARs are shared with foreign affiliates, that can create real challenges in terms of potential binding obligations on the foreign affiliate to share the SAR with others, which would be contrary to US law. So I think it's great that there will be a pilot program to enable sharing, because it can be very difficult for an institution, and this has happened in prior enforcement actions, where something big has happened and one part of the institution's filed a SAR and the other hasn't. Then it raises questions about why that discrepancy. So I think it can be very helpful to share that information. On the other hand, I would urge people to be very careful about sharing SARs because of the risk of the SAR being subject to legal process elsewhere. And I think that issue has to be really evaluated very carefully.
One other thing on SARs is that, the Anti-Money Laundering Act of 2020 is pushing FinCen to revisit some of the dollar amount thresholds, which have not been on CTRs and SARs, I think have not been changed since 1970. And so not adjusted for inflation. And so that's part of the reason you have over 5 million SARs that have been filed, I think, this year, and only a handful, thousand of investigations out there. So, to your point, the question of the utility of all of those SARs. And on the other hand, if you're a financial institution or someone else who's a required filer, taking the risk of not filing is just not worth it compared to filing something that ends up in a database going to nowhere.
Absolutely. To move to the next slide, please. So Matt mentioned the Corporate Transparency Act previously. It was enacted in early 2021 and comes into effect in less than a month. The Corporate Transparency Act is aimed at providing corporate transparency by requiring entities to disclose their beneficial owners to FinCen, to a confidential database that will be maintained by FinCen. It will not be publicly available. Even law enforcement will have to jump through hoops to access the information in the database. This raises a couple of issues. One is just compliance. This will be difficult and administratively burdensome for many entities to comply with this because it also requires updating. And for entities that are formed after January 1st of 2024, there's only 90 days to get in that filing. For entities that pre-exist the beginning of next year, they don't have to file until the beginning of 2025. Now you might say, how do we file? Well, we don't know yet because the reporting form has not yet been released. And so, some speculate that these deadlines could get pushed back. We're hearing from a lot of people who have spotted, issues in the rules, inconsistencies, some might say. For example, there are 23 exemptions to filing. And one that gets a lot of airtime is the large operating company exemption, which is if you're based in the United States, have more than $5 million in revenues consolidated across all your entities, and employ more than 20 people, then you don't have to file. And if you're owned directly or indirectly by such an entity, you don't have to file, but all 20 people have to be at the entity that provides the exemption. And a lot of people, their employees are spread across the organization. So, this is, that was only meant as an example. This is a new act that has to be evaluated carefully. I think there'll be more guidance coming as we start to see it roll out. We'll see what the form looks like. And if you are scratching your head and thinking about how do we comply with this, you're not alone. I think the other thing this might do is for banks, banks are already subject to requirements regarding learning about the beneficial owners of their customers. I would imagine many banks are considering, requiring their customers to disclose to them what they disclose to FinCen in these filings. If not, it's a pretty good idea to think about that. I think the message here, though, is watch this space and think about how this impacts you and what information you might want to obtain from your customers. Next slide, please. So now in the last few minutes of our program, we're going to switch to talking about 2024 and what we expect to see next year in AML. As Matt said, there was a bit of a lull following COVID, but it looks like we're off to the races now. And of course, your internal compliance efforts are ongoing regardless. So, we, in our view, as we talked about this and looked at the trends, we do expect SAR filings to continue to increase for the reasons we were discussing before. And we've been talking about, new trends, but of course, KYC and transaction monitoring will continue to be the bedrock of your AML program. And I think if you remember nothing else from today, it's like easier said than done, right? Those are huge operational challenges, getting all the information, updating it, conducting your transaction monitoring. So I think just focusing, if you continue to focus on the basics, you're in a good place. And as I mentioned, those programs can be very complex. We're just talking about the CTA. I think there's a question there of how it will impact KYC. And then, one thing we've been thinking about is what will happen with transaction monitoring as we move forward. Is there a possibility for artificial intelligence to really help with transaction monitoring? Right now, it can be, even though it's automated, it can be very manual because it requires human review of alerts. And I'm sure there's already some technology assisted review, but we're seeing AI move forward in leaps and bounds, and so I think it'll be really interesting to see how that impacts transaction monitoring.
Just on that point around artificial intelligence, I think the other thing to be aware of is that as your business partners begin to leverage AI and kind of machine learning for things like customer acquisition, for market growth, wallet share growth, you will begin, I think, to see regulators focusing on whether or not those tools, those investments that are being made on the revenue generating side are being matched or at least considered on the compliance side. And so if you are in one of those companies, and a lot of them, a lot of financial institutions are considering just this, leveraging this new technology to help them grow their business, grow their revenues, you need to, as compliance leads, as risk officers, as lawyers, be conscious and raise your hand and say, you know, we need to similarly access these types of tools in order to be able to say to the regulators that we're not short shrifting our compliance efforts and we are investing commensurate with the investments we're making in growth.
Speaking of investment, so just thinking about M&A for a second, I meant to mention this earlier. One area of compliance exposure across different subject matters, but including for AML, is when one entity acquires another and the integration doesn't go well, or the acquired entity, its program is not up to snuff, but it's just kind of left doing its own thing. And then the acquirer basically has bought that risk. And so it's very important in any M&A situation to ensure both that you've done adequate due diligence so you can assess those risks going into the transaction, and then even more importantly, that you're addressing them coming out of the transaction. So as we look ahead to 2024, we'll see what the M&A activity looks like. But if your institution's involved in any deals, you should be thinking about, you know, what risk am I buying and how am I going to address it and integrate this thing into the rest.
Acquisitions are easy, integrations are hard. That's been proven over and over again. One of the few businesses where acquisitions tend to be accretive is financial services. When you look across other industries, it's not nearly as successful, but over and over again, you see that the integrations, the legacy systems are not fully onboarded to your compliance program and your other, and this is a source of regulatory scrutiny, ultimately enforcement actions. It's a great point.
I think we can move to the next slide, Matt. Do you want to?
Yeah, the outlook is it's storming outside and thunderstorms are on the horizon, or whatever the right metaphor is. The enforcement action is going to, enforcement outlook is that there'll be more. And we expect, again, that the 2023 settlements that we previously talked about will be a springboard for additional 2024 enforcement actions. And the reasons why include those that we've talked about, but some others. The Anti-Money Laundering Act of 2020 included meaningful increases in money funding for FinCen and other meaningful increases in headcount, new jobs, new roles. The whistleblower incentives that we haven't fully seen yet are the consequence of are significant. I think we're going to talk about that a little bit later. And then again, the trends that we've already talked about, which is that I think there was a lull and now there is a reinvigorated interest in pursuing these types of cases, and we're going to see that. Mindful of the time, to the next slide.
Awesome. I'm going to talk about the EU AML Authority for a second, but before I do that, I'm going to share with you the CLE code, which is KS, as in King and Spalding, KS-CLE-23-234. I'm going to read it again.
Slowly.
Slowly. KS-CLE-23-234. So you need that for your form to get CLE credit for this CLE.
Next slide.
Cool. So this is really just a reminder that AML is a global thing. Governments around the world are very focused on AML risk. The EU is focused on ensuring that the EU financial system, just like the US financial system, is not used to facilitate illegal transactions. So the European Commission has presented legislative proposals to strengthen AML enforcement in the EU and create the Anti-Money Laundering Authority that we've mentioned here. These plans are underway. We expect it to get set up over the next couple years, and that will be a source of consolidation and supervision for the EU, working with member states to really harmonize laws across the European Union. So more to come there.
Next slide. So I had talked, next slide. So whistleblowers, I want to just talk a little bit more about whistleblowers because we do think this is going to be meaningful in the years to come, and particularly as soon as this year, which is the incentives have been overhauled as it relates to whistleblowers in this space. And what used to be capped in terms of a reward, a bounty at $150,000 has now been increased to 30% of the sanction imposed. 30%. If you think of the billion-dollar settlements, hundreds of millions, 30% is real money. So again, the same question that we've had in the past around whistleblower incentives like this to go to the government. How do you maintain your internal programs? How do you maintain your, an effective employee hotline, effective director mailbox? How do you effectively oversee internal issues to try to keep them from being reported out in the first instance? Very challenging. If you look at the SEC, when they created their whistleblower program in 2020, there's been a huge uptick. There's something like 40,000 tips that go through the SEC, or as reported in, I think, 2020, 40,000 tips. So we expect that this will be a meaningful source of additional inbound leads for prosecutors, regulators, and that you'll see an uptick in the year to come. And just on hygiene, obviously, looking at your internal systems, your internal programs for employee escalation of issues, and make sure that you're dispositioning those, keeping the paperwork in, as Olivia said, but also giving yourself the best opportunity to get ahead of these things is really important.
I do a lot of work on whistleblowing claims, and I just plus one to what Matt just said. It's so important to get across the issues that have been raised, to triage them, because some will be, may be anonymous and lack specificity, so there's not much you can do. And so thinking through that, documenting that. Others will raise really serious issues, and so ensuring that they're escalated appropriately and that you're looking across the organization at the risks that are coming in through those complaints is really essential. Because you can imagine if someone's taking the time to submit a complaint internally, they have it ready on their computer, right? They can send it elsewhere. So those are a very important source of risk and awareness. All right, next slide, please. This is our last slide. We'll end the program right on time. The point here, and I think this is really something we've been talking about throughout the hour, is how important a continued focus on compliance is. Requirements and the way you respond to them are not static. I mean, one of the things that Binance, I think, stands for is like, if your business is growing and you're getting more and more US customers, the US is not going to stand by if you're not addressing those compliance needs.
Right.
We talked before about the importance of updating risks and addressing issues as they arise. So audit findings, MRIs, RIAs, MRAs, resourcing needs, escalate as you need internally, make sure people are engaged. And then, regulators will always look at management engagement and governance. So it's never sufficient to say, oh, well, we had a program and someone was dealing with that. Management is expected to know. So think about that. Think about internal sponsorship and information sharing.
Pulling from a different context altogether, the CFPB, when it started under Director Cordray, was pretty explicit about saying read our enforcement actions, because those are basically your compliance guidance going forward, and then they would hold companies to that guidance, put aside APA violations and the rest. The idea behind looking at what's happening to your competitors, your peers, and others in this space, reading those enforcement actions, which I know the larger sophisticated institutions do, but then doing a hygiene check against what has been found, what has been focused on, scrutinized, particularly for smaller organizations. It's the best practice and something that's essential to staying ahead of the regulators. And then, in conclusion on the compliance, this stuff is very complicated. It's somewhat industry specific, but also crosses industries and challenging. And so it always makes sense to consult a good lawyer who's well versed in the space, get a second opinion, and well, we know two of them, and they're sitting here. So to the extent that you have questions, we don't have time to answer them today because we're literally at the hour, but you can email us, you can reach out to us from our website, and we're happy to try to be helpful to you all and to your businesses. Thanks so much for joining us today. Appreciate your time.
Thanks, everyone.
Bye now.